Hi everybody, and welcome back to video number 2 in chapter 7. When we left off, we were talking about Harley-Davidson's warranty footnote disclosure, and they show here that they've added some warranties and some product recalls and other things. And how do we analyze that? Well, GAAP requires that we reflect the estimated cost of what the company expects to incur in the way of warranty claims. So that is estimated, and we hope that companies wouldn't intentionally underestimate it so as to report higher income, but overstating also does not provide a fair presentation of financial statements either. And maybe they might want to do that to create they lovingly call a cookie jar reserve here to absorb any future warranty costs. And of course that shifts income from the current period to the future. So when we're analyzing, we want to make sure that we look at those deviations from the historical levels or from competitor or peer company levels. All right, short-term debt. Here, the company's looking at an increase usually that they borrow from a bank called notes payable. And it's reported as a current liability because the company expects to repay it within a year. And the borrower will incur interest on that note as time passes. So GAAP requires that the borrower accrue interest liability and the related interest expense each time the financial statements are issued if that interest expense has not been paid. So, as an example, let's assume Verizon borrows $1,000 in cash on January 1. So we're going to debit cash because we've received that cash and credit notes payable on the balance sheet as a liability. In this case, the note bears a 12% interest that's payable quarterly. So we're going to actually pay that on March 31st. So at the end of the quarter then, we're going to accrue interest expense or pay interest expense, as the case may be, on March 31st for $30. Okay. The principal payments on long-term debt that's got to be made needs to be reported as a current liability too, and that's the current maturities of long-term debt. Okay, that which is going to mature within that 12-month period. So note that the current maturity is the principal portion only of those payments that will be made in the upcoming year. And here is a typical loan amortization table. I think this is worth looking at. This is how even your home mortgage would be done. You're going to have an annual payment, in this case, of $224,627. But you'll notice with each successive year, a little bit less goes to interest and a little bit more goes to principal. And as that principal balance goes down to zero over the 5 years that this note was in place. Okay, pricing of long-term debt. When the company requires a large amount of financing, issuing bonds in the capital market is a very cost-efficient way to raise funds. So bonds are structured like any other borrowing, and the borrower receives cash and agrees to pay it back with interest. Generally, the entire face amount, that is the principal, of the bond is repaid at maturity, the end of the bond's life. But interest payments are usually made semi-annually. Okay, so we issue these bonds, and we usually work through an underwriter like Goldman Sachs. I used First Boston, another New York-based underwriter, to do these kinds of things. And they sell the individual bonds, usually in $1,000 denominations, to retail clients and other groups. And then they receive a fee for that underwriting. The bonds are investments for individual investors and other companies, retirement plans, insurance companies, those kinds of things. So interest rates and bonds are very much related. Issued bonds can trade in the secondary market just like stocks do, and they fluctuate even though the company's obligation to pay the principal and interest remains fixed. That's what's on the bond itself. That's what the company's liability is. But the value of that bond will fluctuate. And it fluctuates because of interest rates, prevailing interest rates, as I call it. So it can be higher or lower than what's stated on the bond. And because these bonds compete with other investments, the prices are set relative to the prices of other investments. No surprise there. Just like any competitive market, the laws of supply and demand will cause bond prices to rise and fall. So, there's two types of interest rates. One is the coupon rate. That's the rate that you're going to see on the bond. It's sometimes called the contract rate, sometimes called the stated rate. But the coupon rate, in the old days, you used to clip coupons out of your bond book and send it into the company, and they would send you back your dividend, or interest payment. We use that coupon rate to compute the dollar amount of interest payments that are actually paid in cash to the bondholders during the life of the bond issue. But the market rate is often called a yield or effective rate, key terms there. This is the interest rate that the investors are expecting to earn. And so if our coupon rate doesn't match their expectations, the price of the bond will fluctuate. Okay, cash flows to the bondholders, very important here. They normally expect to receive two types of cash flows. One is going to be the periodic interest payments, usually paid semi-annually. We call that an annuity because they're paid equally in every period. But then at the very end, usually, it's the return of the face value of that bond, usually $1,000, will occur at maturity. And repayment of the principal is called a lump sum because it occurs only once. The bond price is equal to the present value of the annuity payments plus the present value of the lump sum payment. Now, I'm going to guess you have no idea what that means. Most of my students don't. But I have a very easy way to explain this, which is a little different than what's in the book. So I'm going to show you my calculations, and I will attach that as an Excel spreadsheet. So let's take a look. All right. Here, in a few minutes, you're going to see this in the PowerPoints, but this is how I value these bonds. So let's look. Here we have a bond that's going to sell for $10 million. So what we're going to do is we're going to set up I showed you how to do these factors a few minutes ago, but this time we're going to do it on a semi-annual basis. So that's the annual rate divided by 2. And so we use the semi-annual rate here to develop these factors, as I showed you in my previous present value analysis. So again, we're going to show This is a 10-year bond, so it has 20 semi-annual periods. And it's going to pay 3%, that's its face value, on that bond of $10 million, which means our bondholders are going to get $300,000 every semi-annual period. So you see that here, all the way down to the very end, and at the very end, they get their $10 million back, plus the $300,000 in the 20th interest payment. Now, if I take all the discounted, the present values of all these payments, including the last one, it comes out exactly $10 million. That would mean that the investors perceive this to be a good valuation. They don't have a thought that it's over or undervalued. So now then, when we go to slide 25, we're going to change that a little bit. We're going to change just this right here. And we're going to say that it's now the outside investors feel that they should be getting 8%. So what that means, if they feel they're going to get 8% and we have a bond that's paying 7%, they're not going to be happy with that. So you can see that this bond is not going to sell for $10 million. It's going to sell at a discount here for $8.6 million roughly. And then we have slide 26, which is just the opposite. Here, the investors think, hey, that's a really good bond. I only want a 4% annual interest rate, so I will pay a premium, $11 million, over the $10 million bond. So pretty cool there, right? There's also a very elaborate analysis here in one of the slides, and if you're interested, you can see that it works perfectly for that analysis too. Okay, so I will post that Excel spreadsheet as well. So let's look at these cash flows to the bondholders then. They're normally going to expect two types of cash flows: the periodic interest payments, that was that $300,000, and then at the end, that single payment was the $10 million that they get back. And that now I think you can kind of understand how that bond pricing works. It's equal to the present value of the annuity payments plus the present value of the lump sum payment. All right, so if we price that one at par, here's our $10 million, and we're going to see that that is valued at $10 million at par. And then at discount, it's going to be valued at $8.6 million. And then at premium, it's going to be valued at more than $10 million, or $11.6 million roughly. Okay, hopefully you see that. I think that's going to be really helpful when we get to chapter, I think, 24, and we start looking at how we analyze projects. You'll be able to use these techniques to really help you understand how to do that. So in general, bonds sell at a premium whenever the coupon rate is greater than the market rate. And that bonds are priced to yield the return demanded by the investors. And the effective rate is always equal to yield. And on my schedule, that's at the top of the page, regardless of what the bond's coupon rate is. That means the companies can't influence the effective cost of debt by raising or lowering the coupon rate. We are contractually obligated to pay what's on that. And so when we do, we have a premium or a discount. That looks like a good place to stop this video. So for now, we will continue on with our chapter